Every time you place a futures trade, a chain of events happen. From the moment you click buy or sell to the moment your order gets filled. Your trade moves through a real execution process, and most retail traders have no idea what that process actually looks like. The lack of understanding can be quite expensive. It shows up as slippage, misfills, bad order placement, and positions that behave differently than expected. So today we're going to break it down clearly. I'm going to show you how a futures trade works from the moment your order leaves your screen to the moment it gets matched in the market. We will walk through it step by step, so by the end you understand what is happening behind the scenes every time you trade. This is part of chapter 1 of the Lumeric curriculum, and honestly, this is one of those lessons most traders should watch before they ever place their first trade. Hi, I'm Bobby C. Wang, founder and lead instructor at Lumeric Trading. We focus on structured futures education for independent traders. No signals, no shortcuts, just a clear framework for understanding how the market actually works. This is part of our Futures Fundamental series. Everything here follows a defined curriculum built step by step. If you want to go deeper, you will find links to free courses, our comprehensive futures trading program, and the official course book in the description below. Alright, let's get started. Before we trace a single trade, we need to understand who is in this market and what each group is trying to do. Because how futures trading works is directly tied to who the participants are. In the book, I break this into 5 core groups. Let's lay them out. Investors, dealers, including brokers, market makers, hedgers, and speculators. First, investors. These are long-term capital allocators, pension funds, sovereign wealth funds, large asset managers. They are not day trading. They are building positions over weeks, months, sometimes years. Second, dealers and brokers. They are the intermediaries. They route your orders and give you access to the market. And your broker sits here. They are not trading directionally, they are facilitating transactions and earning commissions. Third, market makers. This is one of the most misunderstood groups. Their job is to provide liquidity. They stand ready to buy from sellers and sell to buyers, earning the spread between those two prices. Think of a vendor at a market. If somebody wants to sell, they buy. If someone wants to buy, they sell. They are not predicting directions. They are keeping the market moving and earning a margin on each transaction. Fourth, hedgers. These are businesses managing real-world risk. Airlines hedging fuel, farmers hedging crops, manufacturers locking in input costs. They are not here to make trading profitable. They are here to remove uncertainty from their operations. And finally, speculators. And that would be the rest of us. Independent traders, retail traders, prop firms, hedge funds taking directional positions. Retail traders are some of the smallest players in terms of capital, but we serve a very, very crucial role. We take on the price risk that hedgers want to offload, and in doing that, we help keep the market liquid. This matters more than most people realize, because every price move you see is driven by one or a combination of these participants. The market is not just a group of traders like you and I, clicking buy and sell. It is an ecosystem with different objectives and many different time horizons. And once you start recognizing the key players behind a move, you will stop looking for patterns, and price actions will start to make a lot more sense. Now, let's trace a trade from start to finish. You're watching the ES, the S&P 500 futures. Price is at 6,000. You decided to go long, entry at 6,000. Stop at 5,995. Target at 6,010. You click buy. What happens next? Step 1. Your order hits the broker platform. Your broker is the first checkpoint. It confirms you have enough margin to take the trade. Then it processes your order type, market order, limit order, or stop loss. This is where execution risk begins. A market order will fill immediately, but not always at the price you expect. In fast conditions, price can move between the moment you click and the moment your order is filled. That difference is called a slippage. If you do not account for it, you will consistently underestimate your true trading cost. Step 2. The order is sent to the exchange. From your broker, the order goes to the exchange. For ES, that is the Chicago Mercantile Exchange. The exchange runs a central limit order book, spelled CLOB or CLOB. This is a live record of all buy and sell orders at every price level. Unlike markets like Forex, which are decentralized, futures are traded on a central exchange. Prices are transparent, orders are visible, rules are standardized. That structure matters. it creates a more consistent and observable market. This is one of the reasons why day traders prefer futures. Step 3. The matching engine. Inside the exchange, a matching engine pairs the buyers with the sellers. It follows price-time priority. The bid meets the ask. If multiple orders are sitting at the same price, the one that arrived first gets filled first. This is where liquidity becomes crucial. If you place a limit order where there's not enough volume, your order might not get filled at all, or it may only partially fill. Additionally, during low liquidity periods, spreads widen. That means higher costs to enter and exit trades. This is why timing also matters. Liquidity is not constant throughout the day, and understanding when the market is active and when it is thin directly impacts your execution quality. We're about halfway through. If this mechanical picture is starting to click, go ahead and like the video and subscribe. Traders who understand this level of structure operates with real edge, and drop the word trading in the comments below. We'll send you the 7 reasons why independent traders fail guide. It is completely free and is tied directly into what we're covering here today. Step 4, the market maker. Here's the part most retail traders never see. When your buy order hits the exchange at 6,000, it is not usually matched with another retail traders at the exact moment. In most cases, it is filled by a market maker. The market maker takes the other side of your trade. If you're buying, they are effectively selling to you. They absorb that order and add it to their inventory, the positions they accumulate as they facilitate trades throughout the day. Then they manage that inventory by constantly adjusting their risk exposure to stay balanced. So how do they make money? Well, if the best bid is at $5,399.75 and the best ask is at $5,400, a market maker will try to buy at the bid and sell it at the ask. That difference is 1 tick. In markets like the E-mini S&P 500, that is $12.50 per contract. But it is not guaranteed profit. They only capture that spread if they successfully trade both sides. If they get filled on one side and the market moves against them, they take a loss. Over time, the edge comes from repeatedly capturing small spreads while carefully managing that risk. Again, market makers are not trying to predict direction. They are not trading against you in the way most people assume. They are liquidity providers, and once you understand that, a lot of the confusion around fills, spreads, and order behavior starts to clear up. Step 5. Confirmation and open position. Once your order is matched, the exchange sends confirmation back to your broker and your platform updates. Now you're in a position. From here, every tick in your favor adds to your unrealized profit. Every tick against you adds to your unrealized loss. And this is where market risk comes in. No matter how well you understand execution, liquidity, or market structure, you cannot eliminate the risk of price moving against you. However, understanding everything that happens before that point, how your order is processed, how it gets filled, and who's on the other side of that trade puts you in the best possible position to manage that risk intelligently. Okay, now let's bring this together. Every time you trade, you're operating inside the system, your broker routes the order, the exchange matches it, market maker provides liquidity, and every other participant, hedger, institutional traders, retail traders, is placing orders based on their own objectives. When you fully understand that, things start to make more sense. You know why slippage happens, you know why spreads widen at a certain point, you know what the market maker is doing and why. You know where liquidity is strong and where it is thin. That removes a major source of confusion. On the other hand, if you do not understand this system, you are trading at a structural disadvantage. You start blaming outcomes on luck. You get confused by fills that do not match what you saw on the screen. You trade during low liquidity periods without realizing why your results are inconsistent. And frankly, no strategy can fully compensate for the gap. This is why we build from mechanics first at Lumeric. Not because it is the most exciting part, but because everything else sits on top of it. Order flow, volume profile, institutional behavior, none of it holds together without this foundation. With it, those concepts start to connect. Without it, they don't. Here's what I want you to walk away with. First, there are 5 participant types in the futures market: investors, dealers, market makers, hedgers, and speculators. If you're watching the video, you most likely sit in the speculator category. The more clearly you understand what the other participants are trying to do, the better you can interpret what the market is showing you. Second, every trade follows a mechanical path from your platform to your broker to the exchange through the matching engine and into a counterparty, which is often a market maker. Once you know that path, you know exactly where execution risk and liquidity risk come into play. Third, market makers are not your adversary. They are a liquidity function. They earn the spread, manage inventory, and keep the market moving. Fourth, liquidity is not constant. It changes based on the time of the day, contracts, and order types. That directly impacts your execution quality. This is not random, it is structural, and you can learn it. Fifth, market mechanics are the foundation. Everything else, order flow, volume profile, institutional behavior, builds on top of that. Without it, those concepts do not fully connect. If this gave you a clear sense of what this channel is about, go ahead and like the video and subscribe. We post structured futures education every week, and each video builds on the last. If you're going to follow this, follow in sequence. Comment trading below and we'll send you the 7 reasons why independent traders fail guide. It is free and is tied directly back to the 4 pillars we covered today. If you're ready to go beyond YouTube, the Lumeric trading program walks through the full framework in depth. Market dynamics, trade analysis, risk management, and trading psychology. All structured and taught step by step. You'll find the link in the description. And for those who want more of a personal touch and direct guidance, I offer limited one-to-one coaching sessions where we take a focused, in-depth look at your trading, your process, your decision, and where things need to improve. You can book that directly through the website or in the link below. Our official course book, Day Trading Futures, A Practitioner's Guide for Independent Traders, is also available on Amazon. It is the written version of everything we teach here. Even the preface alone will give you the right perspective before you go further. If you'd like to learn more about futures trading, click this video. You're one video closer to being a professional futures trader. Thanks for watching, and we'll see you in the next one.